Okay, let's just get right into it. Right now, we are seeing something completely unprecedented happening in the car market. And frankly, the data is pretty alarming. We're looking at a perfect storm of macroeconomic shifts that are setting the stage for a massive price correction in the auto industry. My goal with this explainer is to break down exactly what is happening behind the scenes. That way, if you or someone you know is planning to buy or sell a car in the next 12 to 18 months, you can avoid a financial disaster and potentially save thousands of dollars. To truly grasp the scale of what we're dealing with, we kind of have to start here. Hit pause on everything else for a second and just think about this staggering reality. U.S. auto loan debt has reached an all-time high of $1.7 trillion. That is trillion with a T. This isn't just a big number on some spreadsheet. This is a glaring signal of a massive financial bubble that's been swelling over the last few years, and it is definitely starting to show some very serious cracks. So, to navigate this $1.7 trillion bubble, we're tracking 5 major warning signs. 1. The pandemic pricing hangover. 2. Drowning in negative equity. 3. The true cost of ownership. 4. Piling inventory. And 5. The new tariff threat. Let's kick things off with warning sign number 1, the pandemic pricing hangover, which is essentially a massive supply and demand shock. To understand exactly where we are today, we have to look back at how normal supply and demand dynamics were just completely upended. It is actually incredible how quickly things flipped upside down. Prior to the pandemic, in 2020, you, the buyer, actually had the leverage. You could go in and negotiate a car below its sticker price. But then in 2021, a perfect storm hit. Supply chain nightmares and semiconductor chip shortages from overseas meant automakers had to drastically slash production. At the exact same time, stimulus checks were hitting bank accounts, creating this insatiable demand. When you mix massive demand with huge production cuts, well, prices absolutely skyrocketed. By 2022, we saw massive markups, frequently 10 to 50% over MSRP. In fact, by early 2022, 82% of American buyers were paying over sticker price just to get their hands on a new car. And to add fuel to the fire, Federal Reserve data shows that domestic banks drastically dropped their lending standards in 2021. This meant banks were suddenly approving auto loans for underqualified or even unemployed individuals just to stimulate the economy. If you're sitting there thinking, wait a minute, lending money for inflated assets to unqualified buyers sounds really familiar, you are absolutely right. It draws a rather chilling parallel to the subprime mortgage crisis of 2008. Moving on to warning sign number 2. Drowning in negative equity. People are seriously underwater on their auto loans. This right here is the direct, painful fallout consumers are facing today from those inflated pandemic purchases. For buyers who bought between 2021 and 2023 and are now trying to trade those vehicles in, they're finding out they owe far more on their loan than the car is actually worth. The average amount owed on an upside-down car loan has climbed to an all-time high of $6,838. Even worse, analysts report that nearly 1 in 4 vehicle trade-ins with negative equity is underwater by $10,000 or more. Let me give you a wild, real-world example of how trapped these buyers really are. Take this extreme but very real anecdote from Reddit. Someone financed a Ford Bronco for $83,000. Yes, that is a $45,000 markup for a standard Bronco. Today, a new one sells for maybe $35 or $40 grand. That buyer owes tens of thousands more than the car's value. But it's not just rare specialty cars. Another user bought a Tesla Model Y in 2022 for $72,000. When prices were recently slashed, that Tesla's value dropped to $38,000, leaving the owner instantly $14,000 underwater. Millions of people are locked in this exact world of financial pain right now. All right, warning sign number 3, the true cost of ownership, specifically rising rates and insurance. Let's break down the day-to-day reality for a buyer trying to finance a car today compared to just a few years ago. Let's compare apples to apples. Purchasing a standard $31,000 Honda Accord in 2021 versus the exact same priced Accord in 2025. We'll assume a $5,000 down payment for both. In 2021, with a 2.5% interest rate and roughly $150 in monthly insurance, your total monthly cost was $611. Fast forward to 2025, that same loan now carries a 6.3% interest rate, bumping your payment up. And car insurance, it has spiked 50% on average over the last 4 years, pushing your insurance to $225 a month. Your new total cost is $731 a month. Over a 5-year loan, that is $7,200 in extra costs for the exact same vehicle. That's nearly a quarter of the car's original value added purely in carrying costs. So what is driving these payments through the roof? Well, pre-pandemic, you could easily secure a car loan between 1 and 3%. Today, you're looking at an average of 6.3% for new cars and a massive 11.6% for used cars. It is no wonder the average monthly payment for a new car is now $742, with 1 in 6 buyers paying over $1,000 a month just for their vehicle. As a result, affordability has completely hit a wall. Just think about this striking statistic. Almost half of all auto loan applicants have been denied over the past 12 months. Half. Consumers simply cannot afford the elevated prices paired with the sky-high interest and insurance rates. Which leads us directly into warning sign number 4, piling inventory and industry panic. Unsold cars are quite literally piling up. Because half of consumers are getting rejected or tapping out of the market entirely, it's creating a massive backlog. As of November, there are 3 million unsold cars just sitting on dealership lots. To put this in perspective, back in 2022, manufacturers had a mere 18 days of supply on average. Today, many manufacturers are staring at over 90 days of supply. Unsold inventory is up 120% since 2023, and despite dealerships throwing out heavy incentives to move the metal, inventory just keeps rising. This backup is causing immense industry panic. We're seeing major layoffs across manufacturers like Stellantis, Ford, and VW. But Nissan is the prime example of how dire things are getting. Once Japan's second largest automaker, Nissan just watched its profits fall by 90% from the year prior. In response, they announced the elimination of 9,000 jobs globally and a 20% cut in production capacity. They even desperately sought a lifeline by merging with Honda, a deal that completely collapsed. When major players with billions in resources start struggling this severely, it indicates a structural crisis spreading across the entire auto sector. Finally, warning sign number 5, the tariff threat and the potential impact on auto imports. As if the market wasn't chaotic enough, we now have a totally unpredictable wildcard about to hit. We are looking at a newly announced 25% tariff on imported vehicles and auto parts. This is huge because, according to Axios, this could affect up to 45% of all light vehicles in the United States. We're talking about 3.6 million cars built in Canada and Mexico, including massive everyday sellers like the Chevy Silverado, Ram 1500, and Ford Mach-E, plus another 3.7 million vehicles imported from Japan, Korea, and Europe. The U.S. International Trade Commission actually ran a study on this, and they found that a 25% tariff could reduce auto imports by a staggering 74%. It would also increase average auto prices by 5% across the board. However, psychologically, many consumers might just assume cars are getting 25% more expensive, which could severely hurt demand. Dealerships with imported inventory are going to be forced to either absorb these massive costs or pass them on to consumers who, as we saw earlier, are already being denied loans because they can't afford current prices. Exotic brands like Ferrari are already hiking prices by 10%. It's highly likely mainstream automakers will follow suit. It's essentially pouring salt on an already exposed wound. Which brings us to the ultimate question you have to ask yourself. If you were trading in a car right now, are you digging a deeper financial hole? Between sky-high interest rates, insurance spikes, negative equity, piling inventory, and new tariffs, this is a perfect storm. If you're currently underwater on an auto loan, the best strategy right now might simply be to hold on, keep making your payments, and wait until you have positive equity before trading it in. The pressure on this $1.7 trillion bubble is mounting every single day. So will this perfect storm finally force automakers to drastically slash prices and hit the ultimate market reset? Stay smart, know your equity,